I've been a day trader for nearly 40 years. I started in 1987 on the floor of the London International Financial Futures Exchange, and really I was quite a gambler in those days on the trading floor. I soon learned to understand the key differences between day trading and gambling, and I'm going to go through that with you today. If you want to build a career in trading, you've got to treat it as your business and not your hobby. If you're trading for entertainment, like when people go to the horse races or to the casino, that's fine. Set a monthly budget and only risk what you can afford to lose. Go ahead, have fun. But if you actually want to make a living, treat it as your business. Trading can be simple, so use common sense. Make a well thought out plan and execute it rigidly. Ensure you preserve your capital and do not risk losing it all in a short period of time or in just a few trades. You cannot make a profit if you do not stay in business. Keep control of your emotions. One of Warren Buffett's most famous sayings about investing is, rule number 1, never lose money. Rule number 2, never forget rule number 1. And this rule applies to trading. So, trading is different from gambling in many ways. If you bet on a horse race or the roll of a dice, the turn of the cards, the spin of a wheel, there's a clear start and end of the bet. There are only two outcomes. You win or you lose. You already know exactly what you could lose or what you may win at the end of the game. Once you place your bet, you know when the game or the race or the match ends and when the next one starts. However, a trader is the one who decides when the bet starts, because that's when you enter the trade. The markets trade constantly from Monday morning to Friday night. The trader must decide when the trade ends. That's usually when the trade hits the stop loss or the target if the trader is adhering to strict trading rules. However, some traders are forced to exit the trade by the broker when they receive a margin call because they've lost heavily. Even when the market is closed overnight or on the weekend, the game is still being played if you have a position open. In between the start and the end, there are endless predictable and unpredictable potential outcomes. The trader can win or lose almost any amount of money of the amount of money in the trading account within that time. No one else will stop the game for you as a trader, unless you run out of margin and you lose everything. Only you decide. This is exactly why you need to exercise complete discipline. By setting your stop loss and your target as you enter the trade, you are defining the length of the trade and removing your emotions from the decision process by doing this. Professional gamblers are professionals because they understand the game and how to use the tools at their disposal to maximize their chances of coming up short. For example, poker players study theory and practice strategies to improve their games. Market watchers know when to enter or exit a position depending on what happens within the price. Sports fans understand the strengths and weaknesses of each team so they can bet on the right side of the odds. To be successful as a day trader though, you need to know about the markets and the psychology of buying and selling. Here are a few key differences that can help you day trade without gambling. Firstly, have a trading plan. It's important to have a clear plan in place before you start trading. Secondly, develop an entry and an exit strategy so you do not trade spontaneously. Third, learn risk management techniques. In gambling, the amount of money you can lose is limited. In day trading, it's important to have strict risk management techniques in place to protect your capital and ensure your losses are limited. Fourth, key to risk management is learning how to position size and stop loss correctly. Okay, thanks for watching my video today. We're going to go through the 10 golden rules of day trading that I've established over nearly 40 years of trading. The first one is never risk more than 2% of your trading capital in a single trade, but always risk the same amount on every trade because you don't know which trades will work and which trades will not. Secondly, only execute trades where the profit potential at your target price is greater than the potential loss or the point at which you place your stop loss when you enter the trade. 3. Always enter a stop loss when you enter the trade. Number 4. As well as setting a stop loss on each trade, set a daily loss limit on your account. So for example, never lose more than 5% in a day, and quit trading for the day if you hit this limit. Number 5, set a daily target and quit trading for the day if you hit this target, or at least dramatically reduce your risk on each trade to ensure you keep the majority of the profit for that day. Setting targets and sticking to them allows you to clearly monitor your success rate. Number 6, Keep a journal of all your trades, keeping notes on what you did right and what you did wrong, how to improve. Review your trades regularly, at least once a week. Number 7, never move your stop loss price further out to potentially increase the loss. The only direction in which you should move a stop loss is in the favor of the trade as it moves further into profit to protect those profits. Number 8, never let a profitable trade run into a loss. Whenever possible, move your stop loss quickly to break even to give yourself a free, no-risk trade opportunity. Number 9, never average into a losing trade in the hope that the market will suddenly turn around and reverse. It's better to exit a trade and wait for the next opportunity than get married to one idea and nurse a losing trade. Holding on to a losing trade for longer than necessary, it drains your energy, your confidence, and the funds in your account. And it means that you're missing other potential profitable trades. Lastly, number 10, run your profits and cut your losses. But do not confuse this with being greedy. Use trailing stops to protect your profits, exit your trade when your targets are hit. Holding onto a trade too long can stop you spotting and entering other potentially profitable trades.